$23,049.81. That is how much I have accumulated in my stock portfolio over the past 5 years. And I would not have been able to build that much up in my own personal portfolio without these 3 key decisions I'm going to talk about in this video. These decisions are applicable at any age for any investor, but are especially useful for those on the younger side. Also, I am a little bit sick, so if my voice sounds off in this video, that's why. But a little bit of background on me for those who don't know. My name is Josh. I'm currently 20 years old. I make videos about investing and entrepreneurship. I've been investing for about 5 years, starting when I was 15, and 100% of the money in my portfolio was self-funded by me through jobs I've had over the course of the years. And I wanted to make this video for other young investors so that they can understand the 3 key decisions on my path that I made that helped me build up this portfolio. So without wasting any time at all, we are going to get right into decision 1. Decision 1 was committing to learn about the stock market. If you were like me growing up, there was no class that actually taught you personal finance or investments. And even still today, as I'm in college, there are no personal finance classes. Maybe it's just a thing about my university, but I assume it's very similar for other people. So as a young investor, whatever age you are, your biggest asset is going to be your timeline. More time in the market obviously means you have more time for your money to grow and things like that, but that time is pretty useless without the right set of knowledge, which is why it's very important to spend time reading books, listening to some YouTube videos, or podcasts even. By committing to learning, you're setting the stage to build up your own risk tolerance, your own portfolio buildup, and you're going to be able to make informed decisions based on your investment values. I made it a priority when I was younger to understand how stocks operate based on price to earnings ratios, book to market value, and other terms like that that really affect what a stock is worth. I really like the book The Intelligent Investor by Benjamin Graham as a great place to start, or if books aren't your thing, I would recommend listening to people online such as Warren Buffett, who is notorious. I'm sure everyone has heard about Warren Buffett, and even some podcasts. If you're into that type of thing, there are tons of great investment podcasts. It's important to note that the learning process for investing is always going on. Even today, I'm still learning new stuff every single day. And I will say you will make mistakes along the way, but it is that commitment to learning that really keeps you invested in the stock market and learning from your mistakes and also forming your own opinions on stocks so you're not as swayed by market volatility or fear from other people or what other people are saying. Committing to learning about investing ensures that you are going to continually make better choices over time with your portfolio. You'll make smarter choices and you'll have more confidence. Speaking of smart choices, the second decision I made was consistently investing in my portfolio every single paycheck. So when I started my portfolio back when I was 15 years old, I only had a couple $100s to put into it. But this couple $100, I knew that if I was consistent with investing a portion of every single paycheck I had, could build into something substantial over time. And even today, as 5 years later, I sit at $23,000. It may not sound like an impressive amount by any means, but I personally think it is a great, realistic achievement for other people to see that, yeah, it took 5 years and it's $23,000 and people boast these massive returns, but I'm giving you a real, authentic view at what you can make with just consistency over time in the market. My personal philosophy with investing on a consistent schedule was that I didn't have to think about what exactly I wanted to put in. I just knew I would put in a percentage of every paycheck. So my goal as it started out when I was 15 was 25% of every paycheck because for my personal expenses and things like that, I felt like it was something I could spare. What I think was best for me is deciding on this 25% and choosing to stick to it regardless of how much my paycheck was that week or what things I wanted to buy, what video games, things like that. As an investor, especially a young investor, if you can choose to set aside any specific percentage amount, or maybe it's a dollar amount for you, but if you can do that on a consistent time frame, I promise you over the course of even just a couple of years, you will see the growth and you will feel really good about it. Investing consistently also works to even out those highs and lows of the market volatility, and this is known as dollar cost averaging. Dollar cost averaging in layman's terms pretty much means that some days you'll buy a stock a little bit lower, some days it'll be a little bit higher, but over time, it's going to average out into a pretty decent value as long as you're investing on a good schedule. This will smooth out your investment costs over time and will minimize that market volatility. Even small amounts invested over time can grow to be something absolutely massive. And they often do. This is how big portfolios get built. It is small amounts invested over the course of decades. So I'm going to take my all-time return on my portfolio. As you guys can see, we are just about 23% all time. And of course, this is subject to a little bit of change because I switched portfolios when I turned 18 out of a custodial account, but 23% over the past 2 years is money that I have not put in, So on paper, I'm up 23% for that. I would argue that roughly 35% of my total returns, that totaled $23,000, roughly about $8,000 of that over the past 5 years has been stock market appreciation and dividends. But on the other side of that stock market appreciation, that means over $15,000 of what I've put in has been my own money over the past 5 years, which is a large sum to have put into a market and not spend it on other things. It really does take discipline. This is something that every single person watching this video can do, whether it's $1 or $100 every paycheck or $1,000 if you're balling like that. Consistency is absolutely key in investing. And the easiest shortcut I can give you guys to effectively roll out this decision is as soon as you get your paycheck and you account for taxes, immediately before you even think about spending on anything, link your portfolio to your bank account and take a certain percentage, whatever you decide to set, or dollar amount, take it out and instantly put it in and forget about it. Then whatever you have left over, that's your money to do if you have expenses to pay or things you want to buy. But you have to be able to set aside at least a little bit. Pay yourself first is what this is known as. Over time, this consistency is what's going to drive the long-term growth. If I had put in a couple $1,000s to begin with, or I'd waited for the right time to buy in, I would have a lot less money in my portfolio. And speaking of money in the portfolio, this leads me to my final decision. It may sound pretty point blank, and for those of you who are already doing this, trust me, it still makes sense for you. Decision 3 is choosing to start. This takes a lot of courage, and it might sound silly, but investing at a young age is not easy. It's not something a lot of people think about. And if they are, they're thinking from the mindset of day trading or doing gambling things. It's these long-term investments. It takes time, and it's this patience after you start that is extremely important. There is no better day to start investing than today, and it offers a really unique advantage that you will never have more time for your money to grow than you do at this very moment. If that doesn't encourage you to capitalize on the potential appreciation and gains of the stock market, I don't know what will. By starting early, your investments have a much longer time horizon to grow, and the sooner you start, the sooner you'll be able to receive things like dividends and stock market growth, the things that really start to compound your portfolio. And is this starting aspect that you really have to get into. And so for anyone who hasn't started, you can get started with the link in my description. If you like Robinhood, any brokerage will work for something like this, but the goal is you have to start today or tomorrow, whenever the market opens. Put money in, get it invested. I can't tell you what exactly to invest in, but that's what the books are for, and doing your own research is for. Investing takes time, money, and sometimes a lot of energy, and that's not something everyone is willing to do. And a lot of people think that investing is something that you do when you're older, but no, the time is absolutely now. I'm sure there's a couple people watching this video right now that have wanted to start a portfolio or have thought about it, but just haven't yet. And to that, I would say there is no better time to start a portfolio than the age you're currently at. There's, if you're under the age of 18, then I would think it gets a little more complicated. You might have to talk to your parents, start a custodial account, but regardless, it is still a fantastic idea if you make the right investments. I know when I personally first started, it took some convincing to open up a portfolio, but once I proved that I would be the one putting money in and I could do this, and I knew a little bit about the markets, which is where that first piece of committing to learning comes in, and I was thrilled that I was able to eventually start. But if you're over 18, then that part doesn't matter, just start today. It is important to not compare yourself once you start with other portfolios, because honestly, the money that someone else has in their portfolio has no bearing on your life, and it never will. And so whether your portfolio is worth $500, $5,000, $500,000, it does not matter as long as you have started and you are doing your own investments, and that is a very rewarding thing. And I really want to emphasize that this amount you see right here only started with about $500 in my bank account that I invested in. It's taken 5 years to get to this point, which I am extremely proud of, but I think it's a great testament to any other young investor that these 3 decisions can result in big things, and I am proof of that. So commit to learning, invest on a schedule, and start. The only 3 decisions you need to make to build a sustainable portfolio over time. You can start today with the link in my description. Again, I would highly recommend you read The Intelligent Investor by Benjamin Graham. If you have very little knowledge on it, I think Benjamin Graham is a great resource to read, will give you some good fundamental knowledge. And overall, the sooner you start, the better off you'll be. And if you want to see a full breakdown of what exactly is in that portfolio of mine, make sure to click on this video right here. Like this video if you found it helpful. Comment if you're currently investing or if you want to invest. And if you are currently investing, comment. I want to know exactly what you guys are looking at right now, what got you into investing. I'm very curious to know your guys' story as well. And subscribe if you like money. That's all I've got. Thanks, y'all.